week's MFB news. I hope you're all really well. For those of you whose kids have gone back to school, lucky you. Some of us are facing a 2-week half term. When did that start being a thing? Anyway, we've got loads of really interesting stuff for you this week. So first of all, we're going to have a talk about what's been happening with swap rates. A surprise change there for the better, I hasten to add. Maybe the kind of capital markets gods took pity on us, because another thing we're going to be talking about this week in quite a lot of detail is the Renters' Rights Bill. So interest rates, lender criteria changes, and then it's all about the Renters' Rights Bill for you this week. Okay, so let's have a little look at what's been going on with swap rates to kick things off, and actually better news than the last few weeks. So for those of you who watch this video regularly, swap rates are essentially the rates at which the capital markets are lending each other money, or institutions are lending each other money in the city. The swap rates drive the cost of fixed rate mortgages. So if swap rates increase, then we tend to see mortgage fixed rates increase, and obviously conversely, swap rates come down, mortgage rates tend to come down as well. So this is absolutely great news that they have stepped down a bit. Things have been really stuck more recently. So I don't know if you remember, over the last couple of months, things hadn't really moved very much. We weren't seeing a lot of lender pricing changes because the rates weren't moving, so their cost of funds doesn't move. So it doesn't really leave the door open for them to make any changes to their pricing. Then we saw in the last few weeks things start to climb up a little bit, which probably I would imagine is largely due to nervousness around the autumn statement. And I'm going to try and explain a bit more about what goes into swap rates in a moment, so we'll come back to that. But the thing that you guys need to know, which is really good news, is that we have seen swap rates come down a bit in the last week. So 2 years, 3.51. 1 month ago, 3.73, and 1 year ago, 3.98. So actually, compared to 1 year ago, 2-year swap rates almost 0.5% lower now, which is absolutely gorgeous. 5 years, 3.56 as of last night. 1 month ago, 3.81, and 1 year ago, 3.82. So not the kind of big sort of step change that you maybe were seeing for 2-year fixed rates, but actually still to see 5-year swaps down at 3.5% is absolutely amazing. There was a period of time when they just got stuck at 4%, just over 4%. And I remember 4% was kind of like this figure that I became really quite fixated on, God knows why. But I really wanted 5-year swaps to go below 4%. For me, that just kind of felt like a good kind of moment in time. And actually now to be at almost 3.5 is absolutely wonderful. So there you go, good news on the swap rates this week. Okay, so with that in mind, I thought it might be just useful to talk a bit about swap rates and what goes into them, because there is lots of things at play here. It's not just one thing. So it's not just gilt rates, it's not just inflation, it's just not unemployment. You know, there's loads and loads of stuff that go into the mix. So really just kind of to expand on that for a moment, because I do think this is quite useful for you guys to at least have a kind of base understanding of what impacts swap rates and therefore what impacts mortgage pricing. And why do I think this is important? Because actually, if you are understanding of how it all kind of hangs together, then you have the ability to kind of look at the various data that's floating around with regards to things like inflation, unemployment, gilt rates, all these things. And then you can start to see for yourself and start making your own thoughts in terms of what's going to happen with fixed rates. And forewarned is forearmed, right? So it just kind of means that you might be just one step ahead of the game when it comes to what might be happening looking forwards, and therefore that might just facilitate you making better financial decisions. So the first thing that kind of goes into swap rates is going to be very much a kind of prediction of what's going to happen with base rate. Now, we had the inflation news come out for September, and whilst it was at 3.8%, which is way higher than we want it to be, it was still lower than some people had predicted. So actually, inflation was performing at a less aggressive rate than people thought, which therefore means there could be a greater chance of base rate coming down further or faster. Now, actually, you know, let's just wait and see. I'm not saying here categorically we're going to see base rate come down next month or anything like that, but actually the fact that inflation wasn't quite as horrific as people thought it was going to be will certainly have kind of helped with that. Now, conversely to that, and sort of the less positive news as it were, weaker growth and economic softness can also impact swap rates. So recent indicators showing the UK economy is growing really slowly and the labour market is weakening. So essentially what this means is that if growth and inflation pressures ease, then fixed rate funding costs, which swaps help determine, can come down. Now, there's also other stuff that go into this, like reduced risk premia and improved liquidity conditions, and also hedging and demand within dynamics. So lots of stuff that go into the pricing of swap rates, but at least I hope this kind of explains to some extent how, by understanding what's going on with inflation, by understanding what's going on with these different metrics, it's all data that's kind of there if you want to go and dig it out. Hopefully it will lead you to make some kind of predictions for yourself, essentially, in terms of what's going on, and therefore that will kind of help you shape your strategies as you're looking forward with your investment plans for, you know, the year, 2 years ahead. Now, in terms of the swap rates coming down, what does this actually mean for you guys right now in terms of mortgage rates? Well, what it means is that actually it's kind of opened the door for lenders to have a revisit of their pricing and potentially bring things down. So actually what I am expecting to see now over the next couple of weeks is a little flurry of mortgage fixed rate reductions, which is great news. Obviously, if swap rates suddenly kind of jump back up again, that totally undoes that great news, but let's just wait and see. But in theory, based on where we are with swap rates at the moment, we should see a little shuffle in terms of mortgage pricing. Okay, now moving on to lender rates and what's been going on there. And just to say that the reduction in swap rates has only really happened in the last few days. So what we won't have is the full kind of impact of that on the lenders' pricing as yet. However, having said that, we have still seen a little wave of lenders reducing rates in the last week. So Kensington mortgages have reduced just one rate by 0.1%. Maybe there's more to come there. Keystone have reduced their rates and their product transfer rates by 0.2%, which actually, when you think about what's happened with swap rates, makes perfect sense. TSB rates down by 0.2, Skipton down by 0.8, NatWest down by 0.25, Santander down by 0.15, Landbay down by 0.25 on some of their rates, and Paragon HMO rates have also come down by 0.1%. So I think the kind of message here is that actually I do genuinely think we've kind of going to see a little bit of adjustment with the lender pricing changes, as I've said numerous times already today. For those of you with applications in the mix, with particularly those lenders that I've just named, definitely worth contacting the lender or your broker if you're dealing with a broker and asking them to see if you can take advantage of the new lower rate from the existing lender. Looking at that list of providers there, I don't think there's a single lender that doesn't let you switch onto a new rate before completion. So definitely worth doing that. And for those of you who are thinking about making mortgage applications, I just want to say, like, don't go ahead, don't hold off, but actually probably worth just checking that if you do make an application right now, that you're going to a lender who will allow you to benefit from lower rates if they bring them out over the next couple of weeks. Okay, now the Mortgage Works have made by their standards, quite a sizable piece of lending policy change, which sits around shareholders in limited companies. So the piece of criteria change that they've done is they're now accepting limited company applications where there are minority shareholders. So what they mean by this is that a shareholder or multiple shareholders can own up to 20% of the company shares, and they will not be assessed as part of the mortgage application. So their name won't even be sort of mentioned, essentially. There's no credit scoring, no underwriting, they just get ignored. Now, this is actually quite a big move because previously the Mortgage Works had a policy which was that absolutely every single shareholder had to be on the application. So what this means is that if you've got, and this is the one we're coming across more and more, and I'll come into this in a moment, if we have children who are shareholders of the company, that would immediately rule out you being able to go to the Mortgage Works. And actually we like using the Mortgage Works for limited company applications because their pricing is very good, to be quite blunt about it. So it was a real shame that we were having to kind of say no to some of our borrowers or clients to the Mortgage Works because they might have given their kids 10% shares in the company. So the reason that the Mortgage Works have made this decision is that obviously it was costing them business, but more and more landlords are really starting to kind of embrace the fact that they're using limited companies as their ownership vehicle for their investment portfolio for all the obvious tax reasons. And actually using a limited company does kind of open the door for a more varied type of ownership of the company or the properties, which can really help with things like estate planning. So what I mean by this is, as an example, I have a limited company which has a buy-to-let property in it. Now, in theory, I might want to give some of the shares in my company to my son so that actually both now and in the future, he becomes an owner of that company and can stand to benefit from it. And there's loads of ways of doing this in terms of how many shares I would give him, and the types of shares he would have as well, because not all shares in a company are equal. And this is where we move into the realms of you really need to speak to, you know, a tax advisor, an accountant who can give you really good advice on this. But there's actually also other reasons that people might want to have different kind of shareholding in their company. For example, I want to buy a buy-to-let property. I don't have a huge amount of deposit, but actually my dad said he'd lend me 20 grand. Therefore, to make sure that his kind of investment is formally recognised, I might want him to have shares. But my dad actually is just doing a good thing for me. He's just lending me some money. He doesn't want to be part of the mortgage application. He doesn't want to be giving personal guarantees. So there's kind of various ways why actually people will have investors or people with relatively small shareholding in a company who don't want to be part of the bigger application. So is what the Mortgage Works done actually kind of like revolutionary? No, it's not. There are lots of lenders who already have a very similar policy to this. There are lenders out there who actually don't even look at the shareholders. They're really focused on just the company directors. And there are also other lenders who still very much work in the kind of like old ways of the Mortgage Works. So every single shareholder has to be noted on the application. But the reason this is really important is because, like I say, we are seeing people starting to really kind of like lean into the fact that using a limited company isn't just great from a kind of, or can be great from a taxation perspective in terms of the rental income tax, but actually it can be a very useful tool for other things as well. So if you are thinking about setting up a limited company and doing something where the shareholding is not, I don't know, Jeni owns the limited company, Jeni's the director and 100% shareholder. If you're starting to kind of like bring people into the mix on a minority shareholding basis, and you're expecting them to kind of be ignored when it comes to the mortgage, do give us a call and we can talk through the various implications in terms of the mortgages that will be available to you based on the structure. I wouldn't want to say we'd ever advise you to not use a certain structure, because obviously you're going to be doing that because you've had tax advice, and we would never want to kind of challenge that. But I think it's really important that you understand the implications of getting a mortgage by having that structure in place. Okay guys, let's lock in to the Renters' Rights Bill now, because it did on Monday evening get royal assent, so now it's officially been brought into law. So it's not kind of like, and now everything is in place and everybody has to suddenly kind of do things differently. It's going to be rolled out probably, and people are sort of talking about implementation over the next 6 months. But actually the point is that it is coming, it's here, and things are going to change a bit. Now actually, while some people are kind of very anti the Renters' Rights Bill, I do think there are some positives to be found in there as well. And actually, I suppose I'm clinging to the thought that maybe it won't be quite as bad when it comes through into reality. But let's just watch and see. But I thought for today's sake, let's just go through the main changes that you as property investors need to be aware of. Because actually I think there is definitely, there's a whole group of landlords who are like totally across this. There's also a whole group of landlords who are just like, until it becomes law, I'm not actually interested, I'm just ignoring it. So, and that's also fine, by the way. But actually for you guys particularly, it's time to actually kind of now get across what's going on and start thinking about the changes that you can kind of make to prepare yourself for what's coming. So the first change, and I guess some would say the biggest change, is that there's changes to evictions. So section 21, no fault evictions are now abolished. So landlords can only evict tenants under the strict grounds laid out under section 8, which includes antisocial behaviour issues, rent arrears, or if you intend to sell the property or move back into the property. Now, if you do plan to sell up or move back in, you must give the tenants 4 months notice to have enough time to find a new home. If you're unable to sell the property, so you don't ever actually end up selling it, you have to wait at least 12 months before you're permitted to re-let the property, okay? So you can't, anyone who's thinking, I don't like my tenants, I'm just going to say I'm going to sell the property and then just like re-let it out once they've gone. This is kind of all designed to stop you doing that, okay? If you want to get rid of your tenants, you're going to have to go through the very certain kind of process, which is under the Section 8 grounds, essentially. Now, landlords under grounds 4A can reclaim houses in multiple occupation, properties occupied by full-time students, to prepare for the next cohort of undergraduates and postgraduates by giving 4 months notice. There is some kind of difference in terms of HMO landlords and the eviction grounds, just so it kind of helps you guys a little bit. Number 2, periodic tenancies. So periodic tenancies or rolling contracts that don't have an end date are going to replace fixed term tenancies. So your ASTs are going to be no more. Existing assured short hold tenancies will automatically convert to rolling contracts without the need to sign new documents. That's really important. There's nothing actually to be done there documentary wise in terms of the actual transition to rolling tenancies. If there's no written agreement in place, landlords do have to provide one. So if you've got nothing in place at the moment, you need to kind of think about getting something put in place. Now, all landlords must issue information to tenants about the new rules within 1 month of them starting. So actually you are going to have to even contact your tenants and proactively tell them what's going on. Now, the purpose of this kind of change in tenancy is to give the renters the freedom to move home if they want, when they want, for example, if they need to move for work, or to stop them getting trapped in poor quality accommodation. Tenants can give you 2 months' notice to leave the property at any time, but benefit from a 12-month period of protection from the start of their tenancy, which stops their landlord from evicting them and moving back in or selling during this time. Landlords can only end a tenancy if they plan to sell and move back in, or in cases of rent arrears. So essentially, I think what I'm hearing a lot of landlords saying about this one is that basically they're going to be like really vetting their tenants to make sure that they mitigate it so far as they possibly can any need to evict their tenants. That's kind of the first thing. And the second thing is that people are saying that actually they're going to be looking at rent insurance policies as well. So I know that the letting agent that I use for one of my buy-to-lets has been in touch saying actually, one of the main things you can do to kind of protect yourselves in these situations is to take out rent insurance, that if there are any issues actually getting tenants out because they're not paying their rent or there's kind of problems, you can lean on the insurance policy. In terms of the tenant's commitment to staying into the properties, the fact they only have to give 2 months notice at any time, yeah, sure, right. So some people are really kind of concerned about this, but actually I think the whole point of the Renters' Rights Bill and what tenants are saying is that most people, when they find a property that they're happy in, that they is well looked after and that it's kind of like a good landlord arrangement, actually they want to make a home and they want to stay on. So most people that we're speaking to aren't actually seeing the 2 month notice from tenants as a problem. So what people aren't saying is that people are going to treat rentals like Airbnbs and just move in for 2 months and then go again. When people aren't expecting that in the main. I'm sure there will be occasions when this happens, but broadly speaking, landlords don't seem to be as concerned about this. It's more about how you get them out rather than them wanting to leave. Okay, now setting and collecting rent. So landlords can only up their rents once a year, and this can only be to the market rate. Tenants then have the right to challenge this at the first year tribunal if they think the rent increase is excessive. Furthermore, large amounts of rent cannot be charged up front before the tenancy begins, practice often used when letting properties to international students or UK tenants with no credit history or poor credit background. So this is going to be a real problem actually for some people. So actually, whereas before people could say, okay, fine, you're coming from overseas, so I have no sort of reference on you at all. I have no idea whether you're going to be a good tenant or not. Or actually, you're a student, so or you have bad credit. I'll just take 6 months rent up front, and then that kind of like nervousness about you paying your rent goes away. You're not going to be able to do that anymore. What are the implications going to be here for overseas tenants and people with those kind of lower credit ratings? How's that going to impact them? That's really, really worrying. And again, it kind of comes back to the fact that landlords are going to be much more selective in terms of the tenants that they take on, and so there could be a real problem for those people who don't fit into that kind of like A1 rating camp. So not good news, mainly for the tenants actually, so not necessarily the smartest move on the Renters' Rights Bill there. Another thing to know is that bidding wars will be banished to history now. It's become illegal for landlords to accept higher offers than the rent advertised. So whatever you put the property on for rent, that is the maximum that you can accept, even if someone comes in and says, actually, I will pay you more. Can't be done. Tenants in arrears. So landlords must wait longer before they can move to evict a tenant in arrears. A tenant must have missed 3 months' payments before they can be evicted, up from 2 before the law was changed. Additionally, the notice period that must be issued has increased from 2 to 4 weeks. So essentially, if a tenant's not paying their rent, you have to wait for 3 months rather than 2 before you can start eviction proceedings. This comes back to why I think also potentially having landlord's insurance could be really, really useful. I think they cover up to 4 months, or the one that I have does anyway. I'm sure there's better ones out there, but that's one my letting agent was flocking, so I just went for that. Okay, now next one is raising standards. So private sector landlords are now subject to the Decent Home Standards and also Arab's Law, like those in the social housing sector, to make sure tenants' homes are safe, good quality and good value. So landlords will be required to register themselves and their properties on a new digital database, to legally let out their home and demonstrate that they are compliant. It's likely that documents like gas safety certificates will need to be uploaded, but this has yet to be confirmed, and failure to register will exempt you from using certain grounds of possession. So this one I'm not overly upset about. In fact, I think it could actually be a good thing, having a database where landlords who look after their properties and keep them in good condition, and therefore keep tenants safe, particularly thinking about Arab's law, is only to be applauded. And having it on a database which is easily available, I don't think is a bad thing. I'm sure I'm kind of probably missing something here. I think what's going to be kind of really important is how easy the database is to use, how accurate it is, all that kind of stuff, the detail element of it. But fundamentally, I don't think any landlord who lets out a good quality, well looked after, safe home is going to have a problem with having a database where that is kind of essentially noted and demonstrating they have the right paperwork to kind of confirm that this is what they are doing. Now, the kind of trade-off to this, local authorities will be given greater powers to crack down on rogue landlords who fail to comply with the new reform. Civil penalties ranging from £7,000 to £40,000 for a serious breach or repeated non-compliance could be slapped on those flouting the rules. Some 15 new offences have been introduced that will see landlords issued civil penalties. So we're going to have to toe the line, otherwise the kind of financial implications could be absolutely massive. Now, there's going to be an ombudsman who's going to oversee fairness. Tenants will be able to complain for free to a dedicated private sector landlord ombudsman that will provide a binding resolution on disputes. So having an arbitrator actually may not be a bad thing as long as it's fair. So actually, we know that some landlords can do things wrong, but actually not all tenants are necessarily reasonable and fair either. So actually, as long as the ombudsman is kind of there to kind of arbitrate and produce a fair decision, it could actually be quite landlords for useful as well. Now, the bill is also going to be stamping out discrimination. So the bill aims to end discrimination against tenants on benefits by making it illegal to enforce policies such as no DSS permitted or professionals only on rental adverts. Benefits can be considered when assessing tenants' affordability. So if previously you said, look, I don't think you can afford this based on your income. I get that you get child benefit or whatever else in the background, but I'm only looking at the actual income that you earn when doing affordability. Actually, it looks like that's going to be not possible anymore. You've got to look at the full financial picture. I always like this one. Tenants can no longer refuse tenants on the grounds they have children. I've never seen a no children kind of caveat on a rental before, but what I do think is if you're renting out a sort of studio flat or a one-bedroom flat, how on earth could you possibly accept children in there? Like, you have a family of 5. So that one's a little bit contentious, to say the least, in terms of surely you could say no children if the property simply wouldn't accommodate children, particularly safely within that property. Tenants are also going to have the right to request a pet. We've done this one to death already, but landlords can insist that pet insurance is taken out to cover any damage that the pet may cause to the property. One of the things I think people are worried about is a tenant says they've taken out pet insurance and then they cancel it. So maybe a kind of clause in your rental agreement or your tenancy, as a side note, could be to ensure that policy stays in place and it doesn't get cancelled down the line, leaving you exposed. So there you go, they're the main changes. There is loads of information about this everywhere. And we've got some really detailed articles on our website. I'm hoping marketing can put a link into one of them here for you. But likewise, if you are members of landlord associations, if you're kind of signed up to many of the really good landlord forums, this is going to be discussed prolifically actually over the next few months. But as always, we're going to keep you updated as things change, and as things move into law as well, we'll keep you posted with that and what you can do to help yourselves. Okay, so I just want to quickly touch on the fact that we've released our latest in our series of Meet the Lenders, and this time I was really, really delighted to have a chat with Stella Brookman from Fleet Mortgages. Now, Fleet are a lender who we are doing a huge amount of mortgage applications with at the moment. Why is that? Because they've got very, very good pricing, yet they lend to limited companies. They don't mind how many properties you've got in the background, HMOs, multi-units, all those kinds of really good things. So kind of a specialist lender whose pricing is definitely towards the lowest end of the limited company rates. So very, very good. We also really enjoy dealing with Fleet because they are Generally great people, actually, if I'm brutally honest about it, and their service levels are very, very good as well. So interesting to have a chat with them. Stella's a really great lady. She's got lots of kind of fairly strong opinions, actually, and one of them that I asked her was what her views were on the private rental sector, and here's what she had to say.
I'd really love to hear your thoughts on where you see the future of the private rental sector.
It's always going to be there, Jenny, always. You know, the government have not got enough money, they're not building enough houses, they rely on the private rental sector. It's just so imperative for them to make it a bit easier for landlords to be able to buy those properties.
I was going to say, they've got a funny way of showing it sometimes, haven't they?
Yeah, of course they have. So no, I think it's always going to be there. I know people run a little bit scared, but like I say, I think the market is changing. It's going to become more of a limited company portfolio landlord market. And for those portfolio landlords, majority of them will run it like a business. So it's for the long haul, not the short term. So, you know, they're going to make their returns on the yields quite good. You know, a lot of them do it for pension requirements. So no, I have complete faith in the private rental sector, and I believe it's there, and it'll always be there.
Lots of stuff to be thinking about as landlords there, and I hope you found that useful. I do appreciate that some people are very nervous of the Renters' Rights Bill. You know, I'm a landlord, I'm feeling a little bit kind of like, oh God, how's this going to work? Is this going to make me vulnerable, make me more exposed? Particularly as I've had a non-paying tenant right, so I've actually gone through an eviction process, so I do understand firsthand kind of how that looks. So I do get that it's really worrying for people. However, let's just hope that actually when it comes in through into kind of like reality, that maybe it's not as bad as we hope, and actually some of the things in there actually work out to be positive for landlords as well. Any questions, give us a ring, 0345 345 6788, or have a nosy around our website where you'll find loads of information. Have a fantastic week. I will see you same time again next Wednesday.